Dear clients, I'm Richard, Senior Dealer from Phillip CFD. Global equities from Europe to Asia pushed through historical watershed levels on the back of global central banks' stimulus theme. For instance, Japan's Nikkei 225 stock average briefly topped 20,000 for the first time in 15 years, while the stock Europe 600 index eclipsed a record that stood since 2000. Another attention-grabbing rally of the week was the Hong Kong's Shanghai Index, approximately 8% surge after the Chinese authority last month allowed more domestic funds to access the city's shares market through the southbound link. Let's now discuss on the US equity market. Equity investor enthusiasm also showed up in the US with all the four key US benchmarks, namely the S&P 500, Dow Jones Industrial Average, Nasdaq Composite, and Russell 2000 applauding with weekly gains. In fact, large cap benchmarks such as the Dow Jones Industrial Average, which has been underperforming year to date, under the weight of a strong USD due to the heavier overseas revenues, finally outshined its smaller cap peers such as the Russell 2000 on a weekly basis. One reason cited is due to the strong price rally of one of the large cap component stock, General Electric or GE, a global industrial giant, on the announcement of its corporate restructuring plan and a major share buyback program last Friday. In terms of data monitor, it is noted that investors seem to be struggling off the surprisingly weak March non-farm payrolls release as a weather-related outliner, and instead are leaning to last Tuesday's Labour Department report of the highest job openings since January 2011 as a sign of continued labour market improvement. Hence, many believe that the March employment figures was a temporary dent in the economic recovery rhetoric, which, if it adds to the Fed's considerations to delay its rate hike, it might even be positive for the risk-on sentiment. Let's also look at the 1Q15 US earnings season, which is now in focus. Alcoa unofficially kicked off last Wednesday by handing in the disappointing quarterly results that fell short of analyst estimates. As for the rest of the earnings onslaught, data and analytical firm FactSet reported street expectation of a approximately 5% year-on-year decline, of which the energy sector takes the lion's share of the blame. However, investors appear to be taking it in stride, perhaps believing that the EPS decline is likely to be temporary and earnings are likely to recover in the second half of the year. Hence, a sense of equity investors' calmness is reflected in VIX, a common gauge of equity fear, which has tumbled down below the 13th handle. In conclusion, it appears that some of investors' anxiety over the economic data choppiness and the earnings season's speed bump has been elevated by waves of central banks' stimulus. There is also the increased likelihood that the Fed may have reason to delay raising interest rates beyond this summer. Should such a risk-on environment persist, adopting a buy-on-dip strategy may be tactically rewarding. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. With that, I've come to the end of the presentation. Thank you for watching this week's Market Watch. Please subscribe to us on Phillip Capital YouTube channel and Facebook. Stay tuned for more Market Watch videos.